spread is the difference between the bid and ask price. Simple. Spread is the difference between the bid and ask price. Okay, so the difference between 1.2612 and 1.2614, as we did here, is 2 pips. So 2 pip is the spread. Now, let me also explain let me explain further. Spread is the difference, is that difference between the bid and ask price that your broker take in form of commission. They charge you in order for them to place your trades. Okay, some other broker charge you spread and they still charge you commission. But while some other broker, they only charge you spread with no commission. There are some other accounts like standard account that allow you, and no spread accounts. They don't charge you spread at all. They charge you 0 spread, but they take commissions. Now let me explain why there is a spread. Now, if you look at your chart very well, there's always a line, 2 thin line. Okay, that is always following a candle. Is it that red and green? Because you can change this color, I will not want to color code it. There are always 2 lines. Just know that they're just 2 lines. Okay, the first one at the top, the one at the top is bid, while the one at the down is ask. So the difference between these 2 places is what we call this gap is what we call spread. Such that whenever you are buying in this kind of, on this is Euro USD, since whenever you are buying, you'll be quoted at this price. Your buy order will be quoted at that price. If you are selling, and now let me finish the buy example. If you are buying, your buy order will be quoted at that price. Then you'll be in loss immediately. Whenever you enter the market, you definitely read red, because you'll be down 2 pip. We are using this as an example. You'll be down 2 pip. Not until this red line, this line moves up and crosses this threshold, this where the bid price was. And if you cross this threshold, this bid price will move up, while this one will not be here. That is when you now be in profits. So these 2, they never meet. There's always a distance between them in some brokers. Why some brokers, they meet based on volatility. Okay, they meet based on volatility. I'm going to explain that. Just know that whenever your ask price crosses the threshold where you enter in for a buy, that's when you're going to make profit. The reverse is for sale. If you are selling, they'll quote you at this down price, such that whenever this one at the top crosses here, that's when you start making profits. Okay, you understand? That's what a spread is. So the difference between those 2 gaps, that's what spread is. Now, the reason why there are times that spread will meet, there will be no spread, and there are times that spread will be very big. Where spread will always be very huge is when it is close to the New York session close. When New York, they are going to sleep. Okay, whenever New York is going to sleep, spread is always very big, because the weaker markets, which is the Tokyo session, is just coming in. And remember, whenever there's less volume, remember I told you the busiest is London and the New York session. So whenever the busiest, they are going to bed, they are going to sleep, then you should expect a huge spread. Okay, but whenever it is so busy, market is so busy, there's a high volatility, spread is always going to be very tight. But whichever be the case, always run for a very high spread. You want to go to a low spread so that you can get into profit very fast.